Our first speaker for this afternoon is Elizabeth Irungu, and Elizabeth is a CFA by training. She is also the General Manager and Business Development Manager at ICA, in charge of client services. It's her team that actually helps you invest in the video that we heard today. So Elizabeth, please speak to us simply, right? In ways that we can understand and we can be motivated.
All right.
As we see, as you tell us a little bit more about asset management in general, and also throw it in there. Tell us how we can get to ICA if it becomes one of the choices that we're looking at, or who we should have those conversations with in your organization. So karibu sana, Elizabeth, and we look forward to hearing from you.
Thank you very much. Thank you, Angeshi, for that. I'd like just to ask if maybe you can enable me to share my screen, but I'm very, very happy to join this conference. It's a very good session. We are learning a lot and we are sharing a lot of knowledge. I'm very proud to be with my CEO and to be given the opportunity to speak before he speaks. That is I'm more than grateful for that. So just I just take you through a bit of what is asset management. A lot of people, when they hear about asset management, a lot comes into your mind, and I'll just demystify a bit of that and a bit of investments. I'm still not enabled, Anne. I hope I didn't join through the wrong.
Okay, we're just fixing that. You should be able to share your screen in just a minute.
Okay. No worries. But asset managers in Kenya, just to give you a glimpse, we are all licensed by the Capital Markets Authority. I think David is a representative from CMA. Those are our regulators. They give us the ability to serve the public. We are not very many fund managers in Kenya. We're about 23. Some of us are quite old in this space. ICEALION specifically, we are 36 years in. So we've been doing this even before the markets were quite well organized, and we have been at it successfully. So I can tell you, you're speaking, or I am representing a group that has been in the space of investment for a very long time, and we are very proud to be of impact to many families, to many individuals. I still see that I cannot be able to share. Perhaps I don't know. Anne, how do you want me to proceed? Is it technology?
All right, Elizabeth, can you go ahead and try right now? You should be able to share your screen.
It's giving me a host disabled participant screen sharing. Okay, that's okay? Okay, it doesn't.
Sorry about that technology, but just give me a moment, because we, on our side, we're showing that you could share.
You are enabled to share your screen.
I am enabled. Share screen. Good. Yes. You're there, right there. Absolutely.
Sorry about that.
Sorry, people. I'm there. I hope you can see. You can see it really well. Let me put it on full screen mode. So we are ICEALION. I'll not bore you with a lot of we are not, but just know that we are regulated. We are licensed in 2 countries. We are in Kenya, we are in Uganda, and we are managing in excess of $2.5 billion US as a fund manager. So just rolling now to the role of fund managers, just to give you color of what we are supposed to be doing at a very high level. We invest monies on behalf of investors, whether you're an individual, whether you're a fund, whether you're a group, a circle, anybody with monies and they're looking to invest, we are able to give you an investment solution that suits you. We don't work with a one-size-fits-all. A manager is supposed to work with you as yourself and give you a return that is commensurate with the objectives that you're set. We monitor your portfolio. So our work at the back here is to monitor what's happening in the markets, to your portfolio, and on a daily basis, make sure that we deliver on the mandate as your investment manager. We monitor, we control, and we mitigate risk. All investments come loaded with risk, and it's very important to be aware of the risk that any particular investment will come. Anything good good. I can tell you, you'll always come loaded with some level of risk. It's not about being afraid of the risk. It's about allocating the correct risk to the right investors and to the right profile of clients, and making sure that you don't misallocate. You cannot come to a money market fund and I give you an equity sort of return. I'm simply misallocating, because that's not what you're looking for. Then we report regularly. As a manager, we are very transparent. We are supposed to be transparent to you as investors and make sure that we report back to you. No black box. Please avoid anything that is a black box. And soon I'll be telling you some of the things, that the red flags that you can pick from people or from sort of houses that claim to be asset managers, but they aren't. Some of those flags. So reporting is very critical. You're entitled as an investor to a report from your fund manager regarding how they're investing your monies, what is happening on the ground. All good and bad news should be delivered. In terms of, if you are in the equities market and shares have gone down, I should be straightforward and tell you we bought shares, but because of COVID, share prices have come down. That's a report, and it means you are more informed. So I'll tell you 4 P's and 1 T that you need to look at if you're selecting a manager. So we are 23 in the market. How do you choose? You'll go with ICEALION and not these other manager A from manager B. So the choices that you'll make will be determined by 4 things that I would want all of us to keep in mind. 1, the people. Always investigate the manager you're picking. What kind of people are behind the investment house? Are they qualified? And qualifications, there are international qualifications like CFA, there are local qualifications like ICIFA or CIFA, it's called CIFA, CC. Those qualifications mean a lot. It means those people have been trained properly. And so qualifications of the people and qualifications of the company is also very important. And for the company, you're looking at the registration by the regulator, which is very important. And then, of course, the experience that the people who are behind this fund manager have. So have they been in the industry? Do they understand the markets they're operating in? Because it's very different operating in Kenya and operating in South Sudan, just for purposes of an example. So if I don't understand the market that I'm operating in and I don't have experience, most likely I'm going to struggle as a fund manager. Then, of course, the one thing that maybe all Kenyans everywhere, is particularly I single out as Kenyans, ethics. Are they operating in an ethical manner? And ethics, we know, is not, it's tangible and it's not intangible. It's matters of the heart. Sometimes we read news and we say, oh, wamewekelewa, people are putting these things on them. But the truth is, ethics builds trust. Do your clients have trust with you? So ethics is very, very important. And so if there's anything you can pick about the ethical practices of your manager, let them be there. Ask them, how do you operate? Maybe how they acquire their business, so that you understand. Then the other thing is about process. Sorry about that. Another thing is about process, documentation. How do they document the process they follow in terms of investing? Or the process is just whoever wakes up, the manager wakes up and does things. So it's very important to understand the process. They have a process flow that makes sense. Are they driven by research? We say, yes, there are people who are doing a lot of speculative trading and they say they have made money, but I can tell you research is a bedrock of good investment decisions. So it's important to ask, do you have a research team as part of your team members? And that research, what kind of research do you produce? And they can even share with you to show you, this is the kind of research we do. Then, of course, the checks and controls, those are just controls to mean that there is separation of duties between different departments. And then in terms of philosophies, that I don't take so long, every investment manager should have a philosophy that they follow. Then that philosophy needs to be very clear. If you're a fundamental investor, you're not just chasing after alpha or excess return, then you need to demonstrate that you follow fundamentals in making investments. You're not a speculative betting company. So no speculativeness in terms of how they make decisions. That's very important. And then, of course, even if a manager is new, because each one of us had a new day, but it's possible for you to verify the performance of the manager is trying to promise or has delivered in the past. And that should be benchmarked with similar investments that are there. Then, of course, the T is the terms and conditions. Just look out for the kind of vehicles that they are using to deliver the services that they are promising. So, for example, if I am talking about a money market fund, is it registered? You can be able to verify that. If it is not a listed or one, not a listed, if it is not a fund that is regulated, is it possible for me to get the full documentation, what kind of structure that you're using? Because there are many forms of structures that can be used. Now, you go to yourself. So you know the manager, you've been able to profile your manager, you're happy. ICEALION, let's say that. Let's just use that for a good feel moment. Then now yourself, be able to profile yourself. Of course, your manager should profile you, but if you can profile yourself the best, ask yourself the following 7 questions. What is the objective that you are seeking, or the goal that you're seeking when investing? Is the objective maybe to pay school fees in another five years, to buy a new car, to upgrade something, or what is it? Is it your retirement? Ask yourself that question, and the objective will always make you remain committed to it and to the discipline of saving and investing. Then I ask yourself, what kind of return are you expecting? And here you need to educate yourself, because some people come and say, we want to double our money. And of course, the only thing that can double your money is maybe betting, but that means you also have the chance of losing everything that you are doing. But in investments, expectations need to be measured. They go together with the risk, and there's a lot that you can learn about risk and return. Then once you ask yourself about your return expectation, you ask also about the return, because the two, they're like a shadow. One is the shadow of the other, your risk appetite, and differentiate your risk from your ability to take risk. It's okay, you can tell me that you have appetite to take risk, but maybe you're telling me you only earn some little amount of money. So I'll tell you, you don't have the ability to take risk, because we cannot put into a risky asset the little that you're earning. Maybe we need to preserve or be very balanced about how you approach your investment. Then the 4th question will be, what's my investment period or horizon? How long do I want to save or to invest this money? And particularly age. I find it very irrational when an old person comes and says, I want 20%, and you are 80 years. I want 20-30% return, and I'm retired. This is the money I've been paid for retirement. Obviously, that's a mismatch. So your age dictates the kind of risk you can take. When you're younger, you can be able to take more risk, and means that you can be able to ride through market ups and downs, and therefore you're better positioned to take higher risk portfolios than somebody who is more aged. If you're middle there, we will take you to a place where you'll be able to balance both the element of risk and the element of return. Then you ask yourself, are there liquidity needs that are ahead of me? Will I be needing this money soon after I've just put it through? And if you can answer that to the affirmative yes, then you know your risk appetite immediately goes down. So if it is money for school fees, then you cannot be able to put it into a portfolio that takes that has a lot of volatility and may actually jeopardize your objective of maybe going to school. Then the final one you ask yourself is, of course, your personal preferences. We all have what we like, what we don't like. Religion is one thing that you need to consider. ESG, environmental, social governance, considerations, you need to take them. And these are very important questions when you're profiling yourself. So before you make investment, profile yourself, ask yourself these questions, and they will guide you to the direction that you're likely to take regarding the investments that you're making. And when you go to your manager, they'll be able to refine it for you. The next thing that I'll talk about, I don't have any slides, good people, are red flags in investments. And I thought this is very important because we are coming from a backdrop of a lot of pain for some people, especially in Kenya, where we have had quite a bit of pain when people have lost money and they have done everything they could to save the little they had, then only to realize things have gone haywire. So the red flags that I can mention here is, one, watch out for high returns with no risk or very little risk. That is the first red flag that you'll have. And you'll find them on social media. They tell you, you put in, you earn 10% per week. That is just crazy, 40% per month. Where are they investing? Such kind of things. Even before they explain to you many things, just put that one as a red flag that it's telling you something is wrong here, because returns are not made as easy as it may look. We've been in this business. We know that very, very well. Then the second thing that you need to be aware of is when the complexity and the secretiveness of the strategy is unimaginable. You cannot be able to tell what kind of strategy are these people employing. So be aware when you hear things are so complex they cannot even be unbundled for you. That's another red flag to watch out for. Then guaranteed high returns, especially the word guarantee. I know we love to hear, if you give me 10 shillings, you'll get back 10 shillings. These are really nice song to our ears. However, that guarantee element is usually the hooker. And the hooker means at one point you'll come to know even your capital that you put in may actually be under risk. There are very few investments that guarantee returns. And CMA is very categorical. Fund managers do not guarantee returns. They work very hard to deliver the returns even for money market funds, but they do not guarantee returns. Maybe insurance companies can guarantee and you have to pay for it. Then unregistered sellers. You will find things which are being sold all over the internet by anybody, by anyone. Come, I can sell you this. That is another red flag to watch out for. Then paperwork. If there's no paper trail, you cannot be able to show maybe even the agreement you signed, cannot be able to log in and see your details, confirm that this company is actually existing. That's also another red flag. It's not always that will be the case. Sometimes you'll get the paperwork, but the detail is in the small letters that they put in there. Then unregistered scheme. Sometimes unregistered schemes turn out to be they're most of the times the culprit for these kind of bad schemes to invest in. So when there's no regulatory framework, be watchful about that and make sure that you satisfy yourself that you have done your due diligence well. So the fundamentals of investing sounds really easy, but come to realize it's not obvious to everybody. But one thing you need to keep in your mind is that one thing that you need to keep in your mind is that the higher the return, the higher the risk. And in this slide, I'm showing you the kind of relationship between risk and the returns that you get. Now, when you look at the low end, treasury bills will fall as your lowest risk and lowest return. Those two go together. So treasury bills will pay you your 5-6% in terms of return, but also it is the place where you are least likely to lose your money. So you give up high return because you're also saying my money is most safe there. Then bank deposits will follow there. The bonds will come in at the third. Your money market funds will be lying between a treasury bond and a bank deposit. That's why I put money funds there, because I know they are very, very common in the Kenyan market. And so very careful when you find your money market is going towards above the treasury bond yield curves and all that kind of thing. I know that's a lot of jargon maybe I'm bringing in, but yes, be very careful. So money markets will lie in between a bank deposit and a treasury bond, so earning you favorable return but not excessively high. Then corporate bonds and commercial papers will be higher risk than their treasuries. Then equities will come there. Property and REITs will be at another level, and obviously all other forms of alternative assets will come loaded with a bit of risk and will be more to the right side of the graph. So two things to part on this one. In investments, risk is dictated by how easy you can get back your money, among many other factors. But one of the things why we say property is risky is because if you wanted the money today, it's very unlikely that you're going to get that money today. You'd have to wait for a whole process of selling and clearing and with government and other regulatory bodies for you to have the money back. So that's why we say it is risky, but it pays you off because it gives you the return, the upside return. Then always diversify your investments. Don't work with one basket or your eggs in one basket. Try and diversify your portfolio. So that's something that you need to remember. Then in terms of your financial freedom, some of the things that you need to know eliminate debt. I know here we've heard about debt is good. There's good debt, there's bad debt, but eliminate debt as much as possible. Manage your money, don't let it manage you. Plan always, reduce your expenses, increase your cash flow. So if you can increase your cash flows, that's really, really good. Simplify your life. I know that one is a hard one, especially for the millennials. Simplify your life. I heard what Miss Nancy was talking about. When you don't have any goal, you just make your life just easy, but you need to simplify your life. Have goals, save your money, have passive income. That kind of thing will mean that you have financial freedom, even when you're young or you're old. And when you secure it, you secured it for a lifetime. I think I'll end it there. Thank you very much. At ICEALION, we give you investments either as an individual, as a corporate, as a pension scheme, and we are ready to talk to you and give you a solution that fits you and not one size fits all.